In this video, I'd like to talk about the different income sources and how they're treated for tax purposes. I like to refer to this as the 3 different income tax buckets. Now, the first bucket is your ordinary income that you earn through your job or through self-employment. That is the W-2 or your Schedule C or any businesses that you're running. That goes as general ordinary wages, and those are taxed at the usual tax rate, and that's probably the most straightforward category that we have. The next one I want to talk about is the investment bucket, and that is where all your capital gains go, your interest and your dividends. That all flows to that bucket. Let's spend a little time talking about investment income. The most straightforward piece of this is going to be interest income. Interest income is taxed just like ordinary income at the usual rates, and it basically is added to your W-2 or ordinary wages. Let's talk about dividends. Dividends are divided into 2 different categories: qualified or non-qualified dividends. Qualified dividends have preferential tax treatment. And those are the ones that you really want to look out for, because if they're not qualified, they just fall into your regular income tax bucket and are taxed that way. Qualified are not. There are also other things that you have to look out for when you're dealing with dividends, and you're going to see that on your 1099-B. Some of them have 199-A issues. There may be foreign taxes paid on those dividends that you're earning, which would probably be non-qualified. You have to take a look at that and make sure you're not missing any tax credits that you may be entitled to. Now let's talk about one of my most interesting and favorite ones, are capital gains. This is where it gets a little tricky. So capital gains themselves are broken out into 2 different categories. You have long-term and you have short-term. Let's tackle the short-term first. Anything 12 months or less are going to be taxed at your ordinary income tax rates. They're added to your ordinary income as well as the interest and dividends. Now, long-term capital gains have preferential tax treatment. What does that mean? So long-term capital gains have a maximum capital gain tax of 20%, whereas ordinary income tax rates can go as high as 37% through the ordinary income tax brackets, not including additional Medicare tax of 0.09%. Capital gains tax reach a maximum of 20%. And yes, you have net investment income tax of 3.8% if you meet certain thresholds for individuals that are making $200,000 or more, or married filing joint couples that make $250,000 or more, an additional 3.8% in net investment income tax. It's on top of your capital gains tax. So it'll bring the total tax to 23.8%. The long-term capital gains, in addition to the 20% preferential treatment, it also falls into sub-tiers where you can actually get away with paying 0% in capital gains tax. And that's if your overall income is $40,000 or less. And it also bumps up into a 15% bracket and a 20% bracket. The next step up is 15%, which is where most taxpayers fall into, because that range is actually quite large. The 15% tax bracket is from $44,000 to almost $500,000. And that's where most taxpayers fall under. Anything above the 492 number, that's where you're hit with the 20% rate. Always keep that in mind. Another thing you have to remember with capital gains is the capital loss part. Capital losses are treated a unique way. So you're allowed to deduct up to $3,000 of capital losses every single year. That's assuming they exceed your overall losses. Let's paint a picture here. So all capital losses are going to offset your capital gains. So let's say at the end of the year, you have $100,000 of capital gains and $150,000 of capital losses. In your mind, you're saying, "Wait, I lost 50 grand this year. That's an amazing write-off that I'm going to get on my tax return." That's really not the case. You don't get to deduct the full $50,000 of the loss in the year you incurred it. We net those out. $100,000 gain, $150,000 loss. Yes, you have a $50,000 net loss that you can report on your tax return, but you're not going to be able to utilize it. That loss is limited to $3,000 each year. You're going to take $3,000 of a capital loss in the current year, and then you're going to carry over $47,000 to the next year. And let's play next year out. You'll be able to use that $47,000 loss to offset your gains in future years. Let's say next year you had $100,000 worth of net gains. You can take that $47,000 and offset that gain. So $100,000 less $47,000. So you're going to have $53,000 worth of gains that are going to be taxable to you in the subsequent year. Let's say you had a $50,000 loss instead of a $100,000 gain. We're talking about on a net basis. You're going to take a $50,000 net loss. You're going to add $47,000 net loss from the year before, and it's going to yield you $97,000 of a net loss. From that loss, you can realize and take advantage of $3,000 again. So you're going to report a $3,000 loss the next year on your tax return. You're going to carry over the $94,000 of suspended losses to the subsequent year. and the rules are going to continue the same. You can offset any gains or net gains that you have in the subsequent year, and you can utilize and recognize up to $3,000 of net losses on the next year's tax return if you don't have any other gains to offset it, and carry over the rest. And this goes on in perpetuity until you utilize the entire gain. And then you're just going to keep carrying it over. Pretty much, if you don't utilize it, it's lost upon death. And that's the second bucket. Now let's roll into the third one. It's the passive activity bucket. And these are income items or loss items that you realize from passive activities such as real estate investments, so any rentals that you may have, or any investments in partnerships where you're not a material participant, meaning investments in S corporations or other partnerships, LLCs, taxes, partnerships, where you get a K1. These will fall into a passive category bucket. And these all will be reported on your Schedule E. Let's break this down. Let's look at the rental piece first. All of this activity, all the income is going to be taxed at your usual rate. There is no preferential treatment for any of the passive income that you recognize. One benefit is it's not subject to self-employment tax. So you don't have to worry about that, but it will be subject to whatever marginal tax rate you find yourself in for that specific year. The caveat here is that losses are treated differently. Similar to capital losses from brokerage accounts, passive losses will not be utilized in the year incurred if you don't have other passive losses to offset them by. Let's say you run a real estate portfolio, or you just have a couple of rentals, and you've recognized a $12,000 loss in the current year. Let's say you have a $35,000 loss in the current year from your rental portfolio or your rental activity. If your overall income on the tax return is less than $150,000, you can actually utilize up to $25,000 of rental losses against your ordinary income. So what you're going to do is take that $35,000, shave off 25 grand, deduct it on your tax return, and then you have that $10,000 left over that is going to be suspended to future years, similar to the capital loss concept. If you make more than $150,000, all bets are off. You can't take a dollar of that loss, and that entire $35,000 is suspended to future years. The loophole that you can kind of get around here is if you're considered a real estate professional. In order to be a real estate professional, you have to meet certain criteria that the IRS lays out. It's a combination of activities throughout the day, this being generally a principal occupation of yours, spending more time than anybody else on this activity, etc. That way you can qualify yourself as a real estate professional and be able to offset your ordinary income that you may have coming in with the losses from your real estate activity. Otherwise, whether it's from a real estate venture or investments in S corporations or partnerships, if you don't materially participate in those activities, then all those losses are actually going to be suspended and pushed over to future years when you do have income to offset it. And the same goes for all the K1s that you receive from your S corporations or other partnerships that you've invested in a passive way, where you don't materially participate or aren't involved in managing any of those. They'll all fall into the passive bucket. It'll be suspended from a loss perspective. It'll go into future years where you do have income to offset it. So keep that in mind. The losses aren't lost. They're just pushed into a year where you can actually utilize them. And another way to release those losses if you dispose of that investment. So if you have an S corporation that you've been investing in, you ultimately sell off those shares, that's when those are going to be released and you can actually offset your income when it comes to that. Hope that clarifies things a bit for you. If you have questions or there's a topic that you want me to talk about, comment below. I'd love to talk about it on another episode. Like, follow, and share for more tax tips. Thanks for watching.